Americans now hold more than $33 trillion in IRAs and workplace retirement plans like the 401k. Yet only 3 in 10 of us have any plan at all for the taxes waiting inside those accounts. So today on Escape the Clock, we're aiming to answer the question, how much of your nest egg is actually yours? And how much is the IRS just letting you hold? Because that word, tax-deferred, it never meant tax-free. It means delayed. Every dollar you put into a traditional 401k or IRA was a loan from the IRS, and every loan comes due. At age 73, the government forces you to start withdrawing, whether you need the money or not. And when that time bomb goes off, it can result in higher tax brackets, up to 85% tax on Social Security, and Medicare surcharges. These are terms written directly into the tax code, yet almost nobody sees them coming. Here's the cruel irony. The more disciplined a saver you were, the bigger the bill. So how do you find these tax time bombs before they go off? And what does it actually take to defuse them? To answer this, I will be joined by Jimmy Miller. Born in Zambia and an expat for more than half his life, Jimmy has spent 26 years as a fiduciary financial advisor, founded Baobab Wealth and Baobab Wealth Abroad, and he wrote Divorce the IRS, a book mapping the 8 tax time bombs hiding inside American retirement plans. So today we get into the myth of the lower tax bracket in retirement, why a Roth conversion works exactly like refinancing a mortgage, the 4 accounts that every freedom plan needs before you leave work, and the tax surprises waiting for anyone dreaming of retiring abroad. If your plan holds even one pre-tax dollar, consider this your bomb squad training. Stay tuned. Welcome back to Escape the Clock, a show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. Let me paint you a little picture here. You've spent 20, maybe 30 years doing everything right. You maxed out that 401k, you've been getting that employer match, and you've been benefiting from all the compounding, watching it grow the balance from 50,000 to 200,000 to eventually something that might look like real financial freedom. And then retirement, thing you've been working so hard for, finally arrives. So does the IRS. Because here's what a lot of people don't fully expect about those tax deferred accounts. That word deferred doesn't mean avoided, just means delayed. And the taxes that you didn't pay on the way in will be waiting for you on the way out. By the time you get there, the rules might not be in your favor. At age 73, the government forces you to start withdrawing from those accounts, whether you need the money or not. Those required minimum distributions, or RMDs, are treated as ordinary income. They can push you into a higher tax bracket. They can trigger taxation on up to 85% of your Social Security benefits. And they can expose you to Medicare surcharges that almost nobody anticipates. It's like a taxation time bomb. And the cruel irony is that the more disciplined that you were, the more you saved, the bigger the explosion. But today's guest has not just studied this, he's lived it. Jimmy Miller is a fiduciary financial advisor, the founder of Baobab Wealth Abroad, and the author of Divorce the IRS, a book dedicated to helping people identify and defuse the tax time bombs sitting inside their retirement plans before it's too late. He's a lifelong expat born in Zambia who has built his practice specifically around helping Americans avoid these exact landmines. Jimmy, welcome to Escape the Clock.
Happy to be here.
Your book opens with this premise that most people think they're saving on taxes when they're contributing to their 401k, but they're actually taking a loan from the IRS with just terrible terms. Can you take me back to when that context crystallized for you and how you first realized how widespread this misunderstanding was?
Yeah, absolutely. I've been a financial advisor for going on 26 years now. And this really jumped out at me quite early in my career. So I've been preaching the same things for quite a long period of time. In 2021, I wrote a book about it, Divorce the IRS, which I'm sure we'll discuss. But, it's been this way for quite some time. And I've always been amazed over my more than 2-decade career how people still gravitate towards that pre-tax account, that they really believe those deductions today, which as you just described is putting it off to later. It will actually benefit them when, in most circumstances, certainly for the people who are listening to a podcast like this, it probably won't.
Right. And the scale of this problem is actually quite large because Americans collectively hold over $35 trillion in tax deferred retirement accounts. And every single one of those dollars have never been taxed. So at age 73, RMDs are going to really force quite a lot of withdrawals, which are all treated as ordinary income. So maybe start by walking through what this tax time bomb actually is and why a lot of people just aren't really planning for it as well as they should be.
Yeah, well, I find Americans are happy to put off just about any problem they have in life till later. But this one isn't like kicking the can down the road, as we like to say. I describe it more as pushing a wet snowball down a snowy slope, because it's a problem that gets exponentially larger as time goes on and those accounts grow, hopefully, of course, over time. So the book really outlines 8 tax time bombs that most people never see coming in retirement until they get there. And oftentimes it's too late to do much of anything about it. So the book is really educationally focused, designed to bring awareness before retirement to some of these tax time bombs that are coming down the road. You've already mentioned one of them, RMDs. That's when the government starts forcing you to take money out of your pre-tax accounts and paying tax on it. I call the tax deductions people take today a loan from the IRS. And that's because of exactly those RMDs that you just described. A loan always comes due at some point in time. And for sure, the RMDs are just like that loan coming due on the taxes that you kicked the can down the road on. But there's 7 other tax time bombs that I talk about in the book that people usually don't see coming that can start to blow up much earlier in your life than age 73 when you get to the tax time bomb of RMDs.
The decision I think a lot of people try to make when it comes to retirement savings is, pre-tax or after tax. Do I want to make a bet on the tax rate being better today or being better in the future? I could make an argument that it's very difficult to be optimistic about the future with the amount of national debt that we have. The money printing and things like that can add a lot of risk to taxation being the only salvation from the debt that we're in. But still, people are kind of taught that the 401k in particular is the tax saving vehicle they should be using, especially when they're making income. Can you talk a little bit more about why this vehicle can actually be kind of dangerous for people when they're optimizing for today, but not really getting ready for the future?
Yeah, absolutely. I have a whole chapter in the book dedicated to the myth of the lower tax bracket in retirement. Because when I start to talk to people about this, that's generally the first argument that comes up. But I'm going to be in a lower tax bracket in retirement. And I hate it that in our industry, that's really the only thing that's talked about. I find that the laziest financial advisors push people into these tax-deferred accounts, just going with this myth that they're going to be in a lower tax bracket retirement. Now, certainly some people will. Americans are not very good at saving. You've probably covered episodes about that. But your audience, of course, are FIRE people, and they're going to be good at saving. And people that I work with and people that are savers generally aren't going to be in a lower tax bracket retirement. And that's because, all the deductions that they did have, the 401k if they are doing that, the HSA, the child tax credits, the mortgage interest deduction, all those things are gone, hopefully, by the time you get to retirement. And when you factor in Social Security and maybe rental income and dividends and all that, people end up not being in a lower tax bracket. I tell people all the time, this whole idea that you only need 60, 70, 80% of your pre-retirement income in retirement. Most of the people that I work with want at least the same amount or more income in retirement than they did before, because one of the benefits of a job isn't only that it makes you money, but it also stops you 40 hours a week from spending money. And most retirees I know fill those 40 hours a week when they retire with things that generally cost them money. So oftentimes they need even more money in retirement to live the lifestyle that they want to have.
I know that's been true for me. I have all my youth. I have my time. I want to do stuff. I want to travel more. I want to do more activities, learn new things. There's costs with everything. Even doing this podcast has had more costs than I had planned for. Now, it's not to say that you can't adapt and have a good plan that can handle and weather that stuff. But I am curious about the tax part in particular, because I will say that has been my biggest personal challenge is taxes. I thought my tax situation was going to get much, much simpler when I was done with work. And actually it has not proven to be that way at all. What kind of reactions are you getting from people when you're showing them these tax bills, when they have this expectation that everything's about to get easy, but these bombs have been hiding there the whole time?
Yeah, it's a wake up call for a lot of retirees. I try to teach people about provisional income as early as I can in life. Most people, maybe a lot of your listeners, have never even heard of provisional income. That's the calculation the IRS does on you once you get to Social Security age to determine how much, if any, of your Social Security is going to be taxed. So taxes don't necessarily get simpler as you get older and get into retirement. When you have to factor in the RMDs, when you have to figure your provisional income, when you have to calculate how much of your Social Security is going to be taxed, oftentimes taxes can get more complex in retirement for some retirees. And it's a real wake up call. I do get a lot of calls from people in retirement that are now getting those wake up calls, or those tax time bombs are exploding on them, and they're looking for that professional help to figure out how they manage this and if there's any moves that they can make still at this time in life. And there always are, it's never too late to improve the future for themselves.
So someone who might be pursuing financial independence right now and trying to leave the workforce, let's say in their 40s or 50s, what would you tell them is the most important tax planning opportunity that they're probably missing at the moment?
The one that I see the most for those in the FIRE movement is saving enough in a non-qualified account, and also then using those tax-free bucket type accounts. As you know, you can take your contributions out of a Roth before 59 and a half with no taxes or penalties, making it much more flexible without forcing you into trying to do a 72T, a substantially equal payment plan, or things like that get complicated and restrict what you can do and can't do and how long you have to do those programs and things like that. But also to save enough in the non-qualified account. So many people are so into getting money into those qualified type retirement accounts. And there's nothing wrong with that inherently, but there's often an opportunity, especially for those people that retire early, where they have these low income years, right? We have a lot of tax advantages inside of a non-qualified account, especially if you're not making earned income. The brackets for the 0% capital gains rate is quite high, especially if you're married, filing jointly. And you can take the income that an average person wants to take in retirement tax-free, even when there's gains in that non-qualified account. And that opens up the ability then to do Roth conversions if you did earlier in life put a lot of money into pre-tax accounts. And that strategy works really, really well for people. But you have to think about it ahead of time and set yourself up with enough money in those non-qualified accounts to be able to live on that tax advantaged, and then at least take advantage of your standard deduction for those Roth conversions over time. And as your listeners probably know, you generally don't want to Roth convert your whole kit and caboodle in one go. It usually takes many years. So the non-qualified account has to be fairly substantial in order to, have those 5 to 10 years of low to no tax years per the IRS, even though you're taking money out of your non-qualified account, and being able to Roth convert and sometimes even pay a little bit of Roth taxes on that from the non-qualified account as well. So that strategy, a lot of people know about it. It's not a secret, but it's one that I see a lot of FIRE people, or people who want to FIRE, are missing.
Yeah, let's go in that one deeper. I think that's really important because I was at Camp FI and I was talking to a lot of people in the FIRE movement, and there's a lot of interest in Roth accounts and brokerage accounts. But those are the enthusiasts, right? The people who are most adept and educated and trying to be successful here. As I work with people outside that community, I have quite a few people who have dollars in pre-tax accounts, and that's everything. That's their whole plan. It's all 401k contributions. And it had to be a bit of a wake-up call because they were assuming that was the money they would have. They hadn't calculated taxes at all. And so there was a bit of a, well, actually, not only is your withdrawal strategy going to be set at a certain age, but you're going to have to be paying a portion of that away. And so Roth conversions made a lot of sense in that. And also, a lot of people don't realize they have a Roth option now through their employer since the Secure Act, and that employers are supposed to offer you an after-tax retirement account option if they hadn't before. So there's a lot of misunderstandings there, but I want to dive into the Roth conversion strategy because I do think that is a powerful tool. And like you said, I think a lot of people in this community do understand it, but you have to understand how much ordinary income you have. You have to understand what your tax hit is, how to select based on the right cost basis. It can be complicated to do it well. Plus there's 5-year timers and things if you plan on withdrawing out what you contribute there. So can you talk a little bit about the Roth conversion strategy and how important do you see, especially for someone on the financial independence path?
Yeah, absolutely. So I call a Roth conversion refinancing your IRA because I found this is a really good way to explain to people because there's another area in our financial life that people will rush out and spend all sorts of money, and that's mortgages. If you have a 6% mortgage and mortgage rates drop to 3%, almost everybody will go out and pay several $1,000s to refinance that and lock in that historic low rate for the next 30 years. And that's exactly what you're doing when you do a Roth conversion. You're going to pay some taxes now, but you have to remember you're always going to have to pay those taxes. I mean, even if you pass away, unless you give it to a charity, you're going to pay, your kids are going to pay those taxes. There's really no way to get out of it. So by refinancing it, by paying those taxes up front now while the account is still smaller at today's known rates, because nobody has a crystal ball about the future tax rates. But as you mentioned in the opening, man, I think that they could be a lot higher in the future looking at our history of tax rates and where the government is going. But set that aside for a minute. Refinancing your IRA can make just a tremendous amount of sense for people. But as you said, we want to make sure that you don't get into a higher tax bracket. So you have to be smart about it. The other thing that I really stress is to add a layer of complication to it. In the book, I describe something called your ideal number. And as much as I love the Roth IRA, somebody that has all of their money in Roth IRA and not qualified is also not taking full advantage of the system because you want to make sure you take advantage of your standard deduction each year. And as your listeners know, that's the money we get each year tax-free, around $32,000 for married filing jointly. So if you pull that first $32,000, just rounding numbers here, out of your traditional IRA or pre-tax account, you can wipe out the tax with your standard deduction and then use the rest from Roth or other tax-free vehicles like cash value life insurance, things like that, non-qualified account. So tax-deferred accounts aren't all bad. It's just important that you do the financial planning to understand what the ideal number is for your situation in a tax-deferred account.
Really like the way that you describe it as like a refinancing. That's really interesting to kind of see it that way too. And, like if we were all perfect people, we would be able to calculate what's the ideal tax rate to pay based on my situation today. But as everyone knows, it can be complicated. You might want to put the right amount of money in a pre-tax account because you're lowering your ordinary income of that year. You're staying out of a higher tax bracket because of the marginal rate. But then later you want to roll just enough over to pay a little bit of tax now to save yourself on tax later. But how do you know what taxes are later? It can get quite complicated quite fast. So it kind of leads me to this next question, which is a lot of people go, well, it's going to be okay because I'm going to move. I'm going to leave the country. I'm going to go to a lower cost area. Basically, it's called geographic arbitrage. A lot of people I talk to in the FI community do plan this. They either say, I'm going to move to this country or this area because what I save will stretch a lot further and I don't have to worry about taxes anymore. And this is a significant number of people because in 2024, the Expat network said that 5.4 million Americans were living abroad and 23% of them were over the age of 65. So this is a lot of people in kind of the retirement community. So what do people not understand about the tax reality, though, of this geographic arbitrage strategy?
Yeah, it's a really great question. Tim Ferriss kind of brought that to light with his 4-Hour Workweek book, talking about the lifestyle arbitrage, and it became more popular and it's been gaining traction every year. I also get a lot of people interested, and I specialize in working with Americans that are living, working, retiring overseas is what I do every day. What a lot of people don't realize, and maybe your listeners as well, is that America is the only country that taxes its citizens worldwide.
Right.
So I also deal with a lot of cross-border families. I'm married to a German citizen, Sonia. She has a green card here in America, but she's a German citizen. And there's financial complications when you have that cross-border thing as well. Now, Sonia, for example, in Germany, when she's not there, she's obviously not using the roads, the schools, the fire department, the police department. She can deregister, and she's not responsible for any taxes in Germany when she's not there. If she moves back, she can re-register, pay taxes, and have all those services. Americans don't get that benefit. We are required to file a tax return in America if we meet any of the regular requirements like earned income, capital gains, all those types of things in America, regardless whether here or not. Now, with that said, there are a couple breaks for Americans that are overseas because obviously you're not using the services here in America. The first one is the FEIE, or Foreign Earned Income Exclusion Allowance. And basically, in round numbers, that allows an American that's overseas, primarily overseas, more than 330 days a year, to not pay taxes on the first $130,000 of earned income that they earn outside of America. So if you're an English teacher and you're traveling the world and enjoying that, and you make less than $130,000, you still have to file a tax return, but you don't have to pay any taxes because you can exclude it. Now, that comes with some negatives because that income is excluded. You're not allowed to use any child tax credits. You're not allowed to put money in an IRA, Roth IRA, a non-deductible IRA. You can't make any contributions because you didn't actually have any earned income in America because it was excluded with the FEIE. Now, the other thing that Americans could do overseas is the foreign tax credit. So with countries that have a tax treaty, and about 60 countries have a tax treaty with America, for countries where you're going to pay a higher tax rate, which is pretty much all of Europe, you're allowed to use a dollar for dollar credit on any taxes you pay in Europe against your taxes in America. So that's another way. If you're going to pay, $30,000 of tax in Germany, but your tax bill in America was only going to be $20,000, that credit of $30,000 in Germany can wipe out your taxes in America. But you still have earned income in that situation. So for people that make over the 130 or in higher tax countries that still want to contribute to accounts like a Roth and IRA, still get things like the child tax credit, generally FTC or foreign tax credit is the better tax strategy for them. I do meet a lot of Americans all the time that think that once they leave the border, they don't have that tax liability in the States, but it's not true. And most countries around the world are like America in the fact that they tax worldwide income. So you can move to Thailand or Bali, but once you're a tax resident there, and for most countries, that's once you've been there 183 days or longer, you're also going to be subject to worldwide taxes on all your income in that country as well. So it's important if you're thinking about going overseas to consider the taxes in both places and weigh that against that lifestyle arbitrage. It's for sure true that life can be much less expensive in Southeast Asia, but you have to consider the taxes and the complication of taxes and the extra reporting and things like the FBAR and things, FATCA and things like that along the way, so that you can make a good decision whether that's really the right lifestyle for you and if it's going to actually save you money in the long run.
Which countries have the most favorable agreements right now when it comes to tax treaties between the U.S. and themselves?
Great question. So as far as tax treaties go, the UK is actually the best and strongest one right now. So most tax treaties will eliminate a double taxation situation, which is really what we're after. Then you end up paying the tax rate in the higher country. But one of the problems that a lot of people don't foresee that want to go overseas, especially the people that I meet that want to go to Italy or Portugal or Spain, one of these places, is the tax treaty does not recognize things like the Roth IRA. So if you built a big Roth IRA, but your dream is to go to Italy for retirement, Italy's going to tax a Roth IRA exactly like a non-qualified account. You're going to have to provide a cost basis. So if you got $1 million in there and 500,000 is your contribution and 500,000 is growth, when you take $1,000 out, they're going to expect taxes in Italy in the 40-something% range on half of the money that you would draw from your Roth IRA. So there's another thing that Americans going overseas often miss and why it takes specialized planning if you are going to go overseas. One quick tip I can give everybody, if you are thinking about going overseas, sell everything in your Roth and repurchase everything right before you go to reset your cost basis in there so that if you do end up taking money out while you're overseas, you can show a higher cost basis on your investments.
And talk to a tax professional like you. Seriously, like you can save us so much money if you don't know what you're doing. That kind of move for sure.
Yeah, absolutely.
So for someone who is now going, okay, I get it. I should worry about this a little bit more. I'm doing all the saving stuff, but I don't want bombs hiding in my accounts. What are some of the things they should start thinking about today? And is there a baseline plan that everyone should be aiming towards, like a balance between certain accounts? Like everyone should have a brokerage account, pre-tax and an after-tax, or is it really going to just depend on every single individual?
It depends on every individual, but for most people, depending on their income level, they're going to have a non-qualified account, single or joint, of course, if they're married. And they'll generally have a backdoor Roth IRA to non-deductible IRA, and then they'll have their Roth IRA so they can convert that non-deductible IRA over. A lot of people get tripped up as well. You maybe had an episode on this in the past with the Pro-Rata rule. So a lot of people get excited about that backdoor Roth IRA, and then they don't realize that it doesn't really work for them because, they rolled over $100,000 401k from a job years ago, and they haven't converted that yet. And now if they make that contribution to the non-deductible IRA, they can totally do that, but converting that to the Roth is, because of the pro-rata rule, doesn't make a lot of sense. And then they create complication for themselves by building this account with non-deductible money that also has growth in it over time now. And you got to keep those things separate because the growth in a non-deductible IRA is really tax-deferred money and is still taxable. Your basis can come out later or be converted. It gets a little complicated with some of those strategies. But everybody should usually have those three accounts: a pre-tax account, a Roth account or after-tax account, and a regular non-qualified brokerage account.
I would probably add an HSA on top of that if they're able to qualify.
Absolutely.
Do that as well.
That's even better than the Roth.
Yeah. I'm glad you brought up the pro-rata. I think that's great. AMT is another thing that was in my mind a bit that I think could surprise people, especially on the higher income side, because they might think they're okay. And then, you pay the highest of the two. So you'd end up getting hit with that one. But I do think most people are just mostly thinking about tax brackets. I think they're thinking, okay, what's my tax bracket now? What's my tax bracket look like in the future? And the Tax Cuts and Jobs Act of 2017 did create historically low tax brackets, but they sunsetted at the end of 2025. And so I know that people who are thinking about tax bracket management might feel a sense of urgency right now about how to think about changing tax rates and things in the future. Is there anything that you recommend for people when it comes to tax bracket management? I mean, it's hard to calculate a marginal rate of taxes. Is this something you have to work with a professional on, or is this something that people should just stop focusing so much upon?
No, it's a really good question, right? There's things in financial planning that are known and we can control, and then there's all these things that we don't know and we can't control, right? Inflation, tax rates, all fall in that we can't control a bucket. So I generally tell people it's best to use what the laws and the rules are today and to do a future tax projection, a lifetime tax plan, right? Most CPAs are really interested in helping you figure out how to save the most this year. They're not doing a projection out on what your tax brackets might be in the future using today's laws to figure out how to pay the least amount to the IRS over the course of your lifetime just this year. And that's the big problem I have with tax professionals. So generally, when I use my software, and there's lots of different softwares out there that'll do this, you can kind of figure out on today's laws what your future tax brackets will be. And for people, once they generally get into their 30s, what I find is they get fairly stable. You know, they get into a 22 or 24% tax bracket. And then if they're a good saver, like most of your listeners I'm sure are, they're going to have that same type of income going forward because they don't let lifestyle creep come in. And then when they hit that magical number and they can sustain that for life, they retire and that income stays quite stable. So that's generally what I find is the sweet spot for people. So if I do a plan for somebody and you're in the 24% tax bracket and we project you out and you're never going to be in a lower tax bracket than 24 using current laws, well, that makes it obvious that we should Roth convert right to the top of the 24% bracket. Because I'd rather pay 24% now on my money if I know that I'm never going to pay less than that basically in the future. Now, you can get really detailed into this now and say, oh, okay, well, what about effective rates? Because, you know, in the future I'm taking out, we got to effective rate is more thing. And you can look at that, but then you have to also factor in the fact of the growth of those accounts as well, right? So doing a Roth conversion at a marginal rate today at 24 on $100 and thinking about taking it out later at effective rate, you also then have to consider that $100 is going to be $300 down the road when you take it out. And so, yeah, your effective rate might be lower, but you have 2 times or 3 times the money in the account that's being taxed down the road. So it gets a little bit muddy in the calculations, and a lot of people like to argue back and forth, but generally doing a Roth conversion to the top of your current or projected future tax bracket is going to make the most sense for the most people.
Yeah, it's a lot to think about for sure. And then to make it even more complicated, a lot of the rules have been changing, and things like stretch IRAs are pretty much changed at least. And things like doing qualified charitable distributions, there's different strategies for that. Of course, if there's businesses involved, like thinking about legacy makes it even more complicated. So for someone thinking about, okay, I'm trying to do the right things, not just for myself, but for my future children or for that charity that I care about, what types of tax considerations should they be starting to put into their plan?
Yeah, it's a good question. So pre-tax accounts are perfectly fine and more favorable if you're planning on giving away your money. That's the one instance that you're not going to pay taxes from the grave, or taxes when you take the money out, or taxes when you hit the RMDs and you're forced to take it out if you give it to a qualified charity. So if that's definitely something that you want to do, then you need to consider that in your financial plan and make sure your tax professional and financial advisor are aware of those wishes, because that's going to change what I call your ideal number. You're going to want to have more in those tax-deferred accounts if the plan is to give it away. I do meet a lot of people that think the plan is to give it away, but it's to give it away to my grandchildren, and I'm not going to pay any tax if I give it to my grandchildren. And as you know, that's the grandchildren, unfortunately, are not a charity, and they are going to pay taxes on that money. And now, as you alluded to, they only have 10 years to take the money out and pay taxes on it instead of the stretch IRA like they used to have. And most kids inherit the money when they're in the highest tax brackets of their life.
Right.
They retire, they inherit the money when they're 50s, they're making the most money they have, and that can, now they're forced to take it out in 10 years, can push them into quite a higher tax bracket. And oftentimes I see the kids now paying higher taxes to get the money out than what the deceased parents were paying to get the money out. So you have to consider all those things when you're looking at your estate plan for sure, who's going to inherit the money, what the tax brackets are for the kids or the inheritors versus yourself.
Amazing. As we wrap up here, I was wondering, is there anything important that you would want people to know about that they could start to take action on today? It could be with their estate plan. It could just be open that account that they're missing. Like you said, it could be talking to a tax professional. Like if you could broadcast a message out to everybody right now, what would you want them to know?
Educate yourself, learn about this stuff. I mean, not to plug myself, but the book Divorce the IRS. I understand that reading a book about taxes is like the broccoli of, it's like, it's not the most exciting thing, but I promise it's a quick read. It's easily laid out. It'll educate you on all these future tax time bombs. If you're not into reading a book on taxes, I totally get it. At the website for the book, you just Google Divorce the IRS. There is a video series outlining the 8 tax time bombs and some of the myth of the lower tax bracket. So you can watch a series of 2 and 3 minute videos to get the Cliff Notes version. There's also a podcast. If you prefer to listen to it on your commute, you can listen to the book through the first 20 episodes of the podcast as well. There's case studies in it, and it really educate you within 2 or 3 hours of all of this stuff that we're kind of brushing over the surface and talking about in today's podcast.
Beautiful. Thank you, Jimmy, so much for coming on the show. How can listeners connect with you if they would like to get more help directly?
Yeah, so I have 2 websites, Baobab Wealth and Baobab Wealth Abroad. Baobab Wealth is for U.S.-based clients and abroad, obviously, for Americans and cross-border families. Most people ask me right away, what's Baobab? It's the tree of life from the Lion King. That's the Baobab tree. I was born in Zambia. I spent more than half my life overseas as an expat myself. That's why I help Americans overseas, because I've lived it myself and understand the situation that they're in. And since I was born in Africa, I've really been drawn to the Baobab tree and its unique shape. And I often say investing is like planting a tree. If you just plant it and give it enough time and leave it alone through all the seasons, it'll grow to something beautiful on its own. So that's why I use the tree for the logo. So baobabwealth.com or baobabwealthabroad.com.
Yeah, and protect your tree from the IRS. Well, yeah. Thank you. Thank you so much, Jimmy, for coming on the show. Really appreciate it.
Yeah, it's my pleasure.
When I left work, I assumed my taxes were just going to get easier. There would be no more W-2 income pushing me into a higher tax bracket, and no more stock vesting schedules keeping those golden handcuffs tight on my wrist, and also no more fear that a big financial move was going to create some kind of explosive tax bill. And those things did happen. It was actually the new things that started happening that really surprised me. The things that retirees, especially early retirees like me, are never really taught to expect. And I'm not alone in that. When Northwestern Mutual surveyed American millionaires, their number one burning question about retirement wasn't how much money they were going to need or even whether they had outlived their savings. It was actually, how will taxes impact me? So taxes are on our mind. And the people who have already won the accumulation game, we're the ones that are worried about taxes the most usually. And that should tell us something, because Jimmy's first lesson was actually really simple. You can kill the myth of that lower tax bracket. Because yes, the tax bracket will drop when your W-2 income stops, but the deductions that sheltered you while you were working, those evaporate right along with it. While things like dividends, interest, royalties, maybe even rent, that stuff starts flowing in. And here's the part that actually bit me personally. I no longer had a W-4 standing between me and the IRS. I had supplemental income that I was earning, but that still owes quarterly taxes. Now, let's just say that I learned it through a nasty surprise penalty my first year of retirement that I'm now supposed to be calculating and paying those, not my employer. But now I have a calendar reminder a couple times a year to pay the IRS what I've been able to calculate that I've been able to earn. But that's something on me. That's something I wasn't taught. Additionally, as Jimmy pointed out, without the 40-hour day job, nothing is distracting you from spending money to fill that time. Take it from me, when your work is done, your life does really feel like it starts. You have all these goals and interests and things that you can actually start to prioritize. And most of those things actually cost money. His second lesson is a blueprint that we've actually covered before, but it's an important one. Before you leave work, you want 4 buckets: a pre-tax account, a Roth, a regular brokerage account, and if you qualify, an HSA. Then optimize what goes where. Us wealth managers, we call it tax drag. Let's take dividends, for example. Dividends are taxed regularly, so holding those in a brokerage account will just quietly fill up that tax bracket. But if you tuck them into a tax advantaged account, now they'll be able to compound and maximize the return there because you're not losing out to ongoing tax payments. The Roth is that super account because nothing in there is ever taxed again as long as you meet the qualifications. So open it up early enough, wait until you get past the age for withdrawals, then you're never going to have to worry about losing out on any of those returns. And because of that, that's where your high growth assets belong. We call it the rockets. These are the things that can just really, really take off. What you see, the balance in that account, that is the balance you will have to spend. It's very, very powerful. So you can really put in just plain old stocks. You can put in pretty much anything you need, especially things that you see high growth potential. And then there's that brokerage account. And this is where I see most of the mistakes, especially for folks in the FIRE community, because people working towards FI, they understand you need that brokerage account to bridge those years because you're trying to work towards an FI number. But the thing is, typically folks in the FIRE community will just throw the kitchen sink at the brokerage account, whatever you think is going to help you move the needle towards that number. But what that does is it will bleed out your gains to taxes. Instead, fill it with assets that generate no taxable income. These are things like non-dividend ETFs. And you can let that tree grow until you're ready to harvest it for what you need to make it across that bridge. If you have a really broad, low-cost index fund that's not paying dividends, then you're not paying out ordinary income taxes on a regular basis, and you're not realizing any type of taxes at all until you finally decide to sell it when you need to. That's a very powerful strategy. Then, of course, with your traditional or 401k pre-tax accounts, you can put in the lower tax drag stuff, things like bonds. You can put in things that you'll eventually have to pay taxes, but they pay out slower. And you can use that to slow down the tax drag because eventually you won't have to dip into those accounts until later in life when RMDs hit in, or you can start to tap into those earlier to minimize the tax drag even more. So if you put the right investments in the right places, then you minimize how much the IRS will collect. Because every dollar in a pre-tax account is in essence borrowing from the IRS. Eventually, they come collecting. But when you optimize, then you're refinancing those loans. And that leads into his third lesson. He talked about this idea of refinancing your IRA. It makes sense. You wouldn't hesitate to pay a few $1,000s to refinance a mortgage from like 6% down to 3%. Everyone understands the value of that. A Roth conversion is kind of the same idea. It's about paying the taxes now at a known rate on a smaller balance instead of later at some unknown rate on a bigger one. When you do it slowly and properly, you're taking smaller hits today for a peace of mind in the future, all while building up a contingency, since those converted dollars can come back out penalty-free 5 years after each conversion. I cover Roth conversions as both an optimization and an income stream in my book, Escape the Clock. Because it's been such an amazing tool for me personally. Just watch out though. There are gotchas there. It can get complicated, especially with things like the Pro-Rata rule. So you have to keep in mind some of these complexities. Things like old 401ks. If you have multiple IRAs, even a spouse's account, these can make the math messy fast. And that's where tax professionals, they really earn their keep. Now, you might be thinking, Dan, I don't need all this. We're just going to move somewhere else, like to Southeast Asia. And first of all, congrats. That's awesome. Super jealous. That sounds like something I would love to do. But look, if you're thinking that is a tax evasion tactic, it's not going to work because the taxes will follow you. America is the only country that taxes its citizens worldwide. Some of the most beloved retirement destinations, the places like Italy, Spain, Portugal, they don't recognize the Roth IRA at all. Jimmy's tip was actually pretty genius. It's to reset your cost basis before you move. And what he means by this is selling everything in the Roth and immediately just buying it back. And what that's doing is that's marking up the cost to today's market value. And therefore, you've washed out all the gains. Therefore, there's nothing for that new country to tax. But remember, that can get complicated too. So you have to be very careful there, especially if you have a large balance. So you have to remember before doing a move like that, you really, really need to talk to a tax professional. But if you do it right, that geographic arbitrage to Tuscany, it could totally work. You just have to keep in mind, it's a tax plan, not a tax escape. Even death is an escape from the IRS getting its payday, which brings me to the last big area worth revisiting, the legacy that we try to leave behind. If charity is part of your goal, pre-tax money is actually a wonderful tool. It is actually the number one strategy that us wealth managers are recommended to do. Because if you give that pre-tax money to a qualified charity, then all of that deferred tax that you are supposed to pay, well, you simply will never have to pay it. Not by you, not even by the charity. It's a really amazing thing because especially if you use something like a donor advised fund, a DAF, you can put in that stock right away. Charity doesn't have to understand the complications of how to transfer the stock. As long as it's highly appreciated and you have gains in there, that gets cashed out by the brokerage. You don't pay any of the gains on that. You get to take an immediate tax deduction for that year, even if you don't choose the charity that year. You could choose the charity in the future, and that charity will be able to get the cash value, even though it came from a stock. It's a very powerful strategy. But you also have to keep in mind, though, for kids or grandkids, they don't qualify as a charity, no matter how much they might want us to see them that way. And most heirs, they are going to be required to empty an inherited IRA within 10 years. These are newer rules. It used to be that you could designate a beneficiary, like a child, and they'd be able to stretch that IRA out. But now, anyone other than a spouse and a very few limited others are required to empty the whole thing within 10 years, and that usually happens during their peak earning years. And that can be an absolute tax nightmare. And that's not our goal. It's not to create a tax nightmare for the ones we love and the ones we're trying to help. You may not have thought much about this, and that's completely fine. That's why I'm doing this. But I do promise you that the IRS has. They are taking advantage and writing into codes things that will make sure that they're getting their payments one way or the other. So the best we can do is understand that. So we're not paying any more than we have to. And in some cases, we can optimize to actually make sure that we may be paying even less than they might expect. So if there's one big takeaway from this episode, it's this. Stop treating taxes like a chore that comes every April and take them on as a serious risk, or at least a serious opportunity in your plan. Financial freedom depends on it. I'd love to hear from you. What tax time bomb is ticking in your plan right now? And what's your first move to diffuse it? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening. Best of luck diffusing your tax time bombs and escaping the clock. See you next week. That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. The book, the free planner, and the one-on-one time with me are all waiting for you at escapetheclock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.